All right, everybody, before we dive into today's episode, we are brought to you by two headline sponsors, the first one being Elite Sweets. Elite Sweets is redefining the way we think about sweets with their Elite Donuts. The Elite Donut is a better-for-you donut that is packed with 13 grams of protein. They're gluten-free, keto-friendly, and contain only 1 gram of sugar. These have become a staple in our house as we look to have a healthy diet and want products that if we do feel like having that sweet or, having a cheat meal or just a cheat snack, something that's not going to completely ruin our diet. So Elite Sweets have become that. It's a donut. It tastes delicious. It tastes just like those shitty donuts that you're used to growing up, except these ones are high in protein, gluten-free. They're keto-friendly for all you keto dieters out there. And most importantly, in my mind, they only contain 1 gram of sugar. So get yours today at EliteDonut.com or on Amazon. If you use code ShaneWhite30 at checkout, you'll get 30% off your order. And that code works on both Amazon and EliteDonut.com. Again, that code is ShaneWhite30, all one word, and you'll get 30% off your order. Today's episode is also brought to you by routine. When we sleep, we lose between a pound and a pound and a half of water, mostly just from sweating while you sleep, which is something I did not know before I started working with the guys over at Routine. They've come up with a product that they call Morning Routine. It's a single-serve packet that I take every morning, and it contains half an organic lemon, 1 tablespoon of apple cider vinegar, Himalayan sea salt, all 6 essential electrolytes, and most importantly, no sugar. Most people wake up, they grab that cup of coffee first thing in the morning. What most people don't realize is if you wake up dehydrated, which is easy to do when you wake up from a long night's sleep, your body sweats and expels a lot of vapors while you're sleeping. Instead of grabbing that cup of coffee, try grabbing a morning routine packet. Each of these, as I mentioned, is made up of all these great ingredients that helps rehydrate you in the morning, get your metabolism going once again. I just take one of these little single-serve packets, tear one open, throw it into, just a shaker bottle or 20 ounces of water, shake it up, and drink it first thing in the morning. You feel a difference. You really do feel hydrated again. You can tell the difference when you use the product and then go off of it again, the difference you feel first thing in the morning. Routine, trusted ingredients, made convenient. You can go to yourroutine.com and use code ShaneWhite30. Again, ShaneWhite30, same coupon code as the last brand, Elite Sweets. If you use code ShaneWhite30 at checkout on yourroutine.com, you can get 30% off your first order. All right, everybody. I have a great guest coming up next, and I will talk to you in just a second. All right, everybody. Welcome back to another episode. I'm pumped today to talk to Blake Wiley. Blake, welcome to the show.
Hey, Shane. Thanks for having me. Really appreciate it.
Absolutely. For everyone listening who doesn't know who you are, would you mind giving everyone a little bit of a background into you and Access Capital and everything you're doing?
Sure. Blake Wiley in Dallas, Texas, and we invest in a variety of different businesses, primarily food, beverage, pet, personal care, and apparel companies. Started off being more kind of Texas-based or, Austin emerging brands, and then kind of went national after that. So, invest, check size is typically kind of a range, $500,000 to $15 million, sometimes a little more. And we have a committed fund that we invest out of, as well as SPV investments as well, which we can get into.
Awesome. Very, very cool. The first question, and the impetus, which I know I reached out to you on LinkedIn and told you this too. A lot of the guests I've had on here are founders of the types of brands that you're interested in investing in. And my background's in finance. This podcast, when I kicked it off during COVID, just to give you a little bit of a background, Blake, it was very finance focused. I worked at RX Bar at the time. And so it was more about investing and personal finance and just more of that overall, I guess, realm, I would say. But lately I've been thinking it'd be really, really cool to have someone like you on, just to give a lot of my audience, who again is a lot of the CPG food and beverage space, the people that are running these brands, to learn more about what goes through your process. And personally, I've always loved this space and have gotten more and more interested in it as I've worked with brands, and just seeing it on the other side once they close deals. And then obviously while I worked at our X Bar, seeing that massive deal close was a fun experience. So I'm excited. For everyone listening, would love to know, obviously it's what you do now. How did you get into this? Like, what was the 0 to 1 story for you? Like, is this what you've always done, or did you do something else before Access Capital and investing?
Yeah, definitely not the typical path. A lot of investors pride themselves, that they were founders, right? So they can view the company from the founder's perspective. They know what the founder's going through, and the peaks and valleys, highs and lows, and all that. And that's definitely not me. I always tell founders I'm just in awe of them. I've never been the person that can look out at the world and say, what's missing is this product that I'm going to go create out of thin air, and everybody's going to add it to their daily routine. That's just not me. I've definitely, even from a young age, was more kind of trend spotting, and felt like a little bit of ability to maybe see around the corner what's coming next type situation, and then really get behind those companies and help drive growth for them. So I'm always in awe of founders. I love investors that are former founders. That just wasn't me. I started off growing up in a small town out in West Texas. I went to school down in Austin at the University of Texas. Started off in the oil and gas business. Is pretty cliche growing up in West Texas. And I had a buddy in 2009 that had sold a tea company, and he was down in Austin. And classic startup story. Great idea, a very small amount of capital, and grew that into a very successful business. Was starting his second venture, and so it was kind of by accident really at first, and then very intentionally after that. He just went around to friends and said, "Hey, I'm about to kind of get the band back together and launch this other business that I think could be successful." And that was my first foray into what a pre-money valuation was, what a liquidation preference was, a convertible note, all these terms that weren't necessarily in the energy business. And started off investing my own personal capital into that business and serious business and similar businesses, which was not much money at all. Had to kind of beg, borrow, and steal to get started. Thought I had shortly thereafter. Thought I had the right deal flow that would be attractive to investors that didn't look at CPG deals all the time. So that original investment led on to some other opportunities that we followed up with, and then I formalized Access Capital. Left the energy business in 2015. Formalized Access Capital, and really what I saw was being in North Texas. I talked to my buddies in Austin, and everybody in Austin looks at these type of businesses every day.
Okay, yeah.
That's not how it works, right? Dallas is a very hard asset town. It's energy, it's real estate, and it's banking. And if you're not one of those three, people just don't know what box to put you in. And so every bone in my body kept telling me to get back down to Austin, move back down to Austin. And then when I looked at it and kind of did an analysis of the amount of capital that is in North Texas and Dallas that might be interested in an asset class that's not correlated to those other asset classes and has the potential to provide outlier type returns, planted the flag here, and we've become somewhat of a beacon for the kind of North Texas investing community and definitely the CPG community.
That is super cool. So for you, yeah, I mean, like starting off putting your own capital in, was it more of you're sitting there, you have a buddy who thinks he has a good idea, and you're like, yeah, I think this is a decent idea. And so what was that process like? Because I've done a few small investments like that now too. And, me being a finance guy, obviously I wanted to do a lot of due diligence. But that first deal for you, was it as much due diligence as you're doing today? Or was it more of just like, hey, I trust you. Like, I think, if it doesn't work, whatever, but you're my buddy and I want to see if this works.
That first one was betting the jockey and hoping he was riding a winning horse is what it was.
Okay.
Totally believed in the founder. Didn't know. I mean, there was not due diligence. there was a similar product that had come to market that was using bad ingredients, high fructose corn syrup, all these bad things. And we were spending a lot of time on boats in Austin at the time, and friends kept showing up on the boats carrying this bad product that was terrible for you and gave you a terrible hangover. He said, "You know what? I could make a better, much better version of that has that Austin identity to it." So that was
cool.
really the due diligence. And then the biggest part of due diligence was coming up with the capital to make that investment right, and having to go to family really and ask for, I have this much, I'd like to invest this much. Can I get a personal loan, kind of situation? And fortunately it worked out, but which is a blessing and a curse, right? Because I kind of tell people it's like going to Vegas your first time and you don't have any money, and you win $5,000 playing blackjack. You think, "Well, I'm an extraordinary blackjack player." And so there were a few lessons after that. Just kind of some too much risk that we took immediately following that, where we were maybe investing in a pre-revenue type beverage company. Something that was had similarities to the original business, but just didn't have. All the magic didn't come together, and fortunately that was still with personal capital and not investors' capital. But since we've formalized Access Capital and taken other people's hard-earned money and tried to grow those investments, we've had a really, really strong track record.
That's really, really interesting. Blake, one thing that comes to mind as you're telling that story, that first investment you made, and you said you took out personal loans with family and friends. So was your concept there, because I had never thought about doing it that way, that you're borrowing from them at a low interest rate, and then your hope is that the company sells, you make a lot, and then you pay them back, and then they make their interest, or or do they have part of the equity?
Yeah, I was still a young guy, and I think I had a passion and really. Whether it was misplaced or, it ended up being right, but I had a strong belief that this was the best place I could possibly put $1, but I need this many dollars to put in it. And I was a young guy in the energy business, not making a lot of money, and so I would just pay him back with a small amount of interest and pay him back over the next kind of 12 months. So.
Wow. Very cool. Yeah. No, it's just really, it's funny. There's like so many ways to fund things, right? So even that example for people who are listening, I get that question sometimes from folks of just like, how do you even get involved? But it's a good example of you just kind of figured it out and you did it.
Beg, borrow, and steal, and it was kind of, there's probably not a chapter written in Rich Dad, Poor Dad to do it the way that I did it. That's how it happened. So.
Right. And so that must have been, like you just said, that was a little taste of what can happen, with this type of industry. To me, it still feels like I would love to know the leap from going from, it sounds like maybe not paying very well, but probably a sturdy business or job in the energy business, to then jumping to start your own Access Capital, your own investment firm. What was some of the process there? Like just making that jump? I'm sure that was a big decision.
It was really the 80-20 rule. I was spending 80% of my time on. My heart was never really in the energy business. I did it because coming out of college, the most successful guy I knew at the time offered me a job, and so of course I'm going to go work for him. But it never completely made a lot of sense to me. I couldn't look at engineering and geology maps and figure out. I knew finance and I knew how to raise capital and those things. But I knew the financial return aspect of it, but not the kind of geology and engineering aspect of it.
Sure.
It kind of felt like maybe I was living someone else's life or something, and spent 80% of my time. And at the end of the year, I looked and it was 20% of my income. And then on the CPG consumer side, I was spending 20% of my time. Whenever we'd have an opportunity that would come along that looked compelling, I could chase it, and it was 80% of my income. And you do 12 to 18 months of that, you realize, okay, well, if I spend 100% of my time over here, and it just always, being able to fund and finance a founder's and entrepreneur's vision and dream and be on that ride was something, you touch, you taste, you feel, going to a friend's house and the wife pulls out, a cracker, right? Or a chip, and you're like, oh my gosh, like, why do you buy that? And it's incredible, and they have these flavors in there, and I'm sitting there thinking, okay, well, we invested in that company 6 months ago, like, and that happened time and time again, right? And so that's what I love about CPGs. You can follow it on social media. It's touch it, taste it, feel it. You go to the store. Is the shelf empty? Is the shelf full? Are people buying? Or what are people saying about it? What are the comments? And you just can't do that in real estate, right?
Right.
I have an investor told me one time. He said, I never get excited that I own 10% of an industrial building in Irving, Texas out here.
That's true.
I think the trade-off is, right, those other asset classes are like a monthly or a quarterly dividend check, and you can kind of track it in real time. And ours isn't that. Ours is we're growing. Okay, it just got marked up because this new investment came in and revenue's way up. Profitability's right around the corner. Just got more distribution and all those things. And so, and then you hope that you somehow could monetize. If you have a good business, you monetize it one way or the other. I will bring up, because you mentioned kind of the current environment.
Yeah.
Is a conversation. I'm sitting on the board of Venture Dallas, and we had a big conference last week, and some of these families that have historically invested in oil and gas, it's got the difference is I think in those kind of cyclical industries, whenever prices are low is like when you want to buy, right? When you want to come in, and venture isn't that. Venture is like, it can go to zero. Like, you don't. There's not really like the perfect time to really enter or exit, right? You can never time it perfectly.
That makes a ton of sense. Yeah. I mean, on that note, it does seem, I would love to get your perspective. You're obviously at the grassroots of it. And then I told you what I do with my agency. We're on I would call it the front lines, where I'm seeing across a variety of brands what sales online are doing and what the trends are. And one thing that's been really interesting, and again, I'm always very careful about what I hear, right? Because it's always anecdotal and everyone's got a different perspective depending on what you're reading. It seems like there's a lot of sentiment out there today that investing cash is drying up. It's getting harder and harder to raise capital. And to some degree, I'm sure that is true. But what's been really interesting to see it, again, on the e-commerce side of things, sales just continue to grow across the different categories that they haven't slowed down at all. And typically November is a month where, especially for better for you food and beverage, I see a ton of drop off. Just people are, they're more worried about the holiday eating and gift giving than they are buying better for you food and beverage brands. This year is the first year that I've ever seen where November is outpacing a lot of brands October. And we're seeing that across a lot of studies that me and my business partner follow. It's been really interesting to see, because I think it kind of is counterintuitive to what is happening in other sectors and just fundraising in general. But on your side of the fence, how does it look for you? Like, do you feel like there's a lot of opportunity out there? Do you feel like cash is kind of drying up? And be really curious for you and your actual firm, what things have looked like and changed over the last year.
Yeah, we have a ultra high threshold for dollars out the door right now, and so it's a little different. Writing those checks, it's definitely it's kind of like in for a penny, in for a pound. Like it's no longer like, here's all the opportunities in front of us. These are the no. These are the definite yes, and these are the, I could see how that could work. Let's put a smaller check in. There's not really any of that going on. It's really 100% really high conviction.
Okay. It's either a hell yeah or hell no kind of thing.
Right. Yeah.
Yeah.
Really, profitable businesses or line of sight to profitability. A lot of changes, going on in the industry. It's tough, from iOS update to inflation to labor shortages to transportation costs, and that's what makes CPG different than tech. Right? Tech, I can make something and sell it 1 million times on a phone. We have real products that have to be manufactured, and they have to sit on a truck and get to where they're sold at, and the grocery store has to sell them. But to the trends that you're speaking, we're seeing the similar things. Everybody's keeps waiting for this big recession to hit. We all know, amounts of debts on credit cards are at an all-time high, and so people are continuing to spend, and but that feels like maybe something's coming. But I think with the categories that we're in, if big recession hits, I don't think that people are going to stop drinking less water. Not, what I see that spending is probably, and I look at my own personal budget monthly, our families, is I think people probably are eating out at restaurants less and eating in more, which drives them to the grocery store aisle more, which gets velocity and revenues up for, brands, packaged brands that we're in, right? And so I think we're seeing that. Going into 2023, I wouldn't want to own, a bunch of high-end hospitality. I probably wouldn't want to own a bunch of, restaurant. I think people are going to be, families will be eating in more, and maybe that drives more trial, And when COVID, March 2020 originally hit, it was hard to drive trial because everybody went to their core, they went straight to the core products that they could trust, they were familiar with and could trust. But I think today, now that we're going into potentially a recession, it's more. I think you'll see a lot more trial.
Okay.
People aren't running to the grocery store because they need to shelter in place right now. They're going there because they're trying to cut back on spending out at restaurants and things like that.
That makes a ton of sense. I could totally see that being the case. And I would think channels across the board, e-commerce, retail, all of those will see a little bit of a bump from that. I could totally see that. For you, I know.
We watch consumers trading down, right? And, maybe instead of the name brand sparkling water, they're buying the private label sparkling water. But we have some businesses that do that as well. So it's we feel what I've been telling people is everything that we can control is within our control. We feel great about where the businesses are, our selection of businesses, and check sizing into those businesses. We feel great about that. All the stuff that's outside of our control, that whatever I do can't affect it. I mean, I just can't stay up at night worrying about those things.
100%. Yeah, no, it's a good point. One of the things that was really interesting is I was doing a little research, and this is just my 2 cents. For the firm that you've created, one thing that I went back to a couple different interviews that I watched of you over the years. You guys have always, it seems like, been very profit focused, which in my mind, if I was ever in your shoes, just genuinely would make a ton of sense to me. I've always been very intrigued by a lot of the funds that have been investing in really low profit firms or just companies in general. And that seems like that's changed a lot in the last year. So for you, is that something you see a lot in your industry in general? It seems like that sentiment has almost done a 180 in the last 12 to 18 months of firms that were investing in low profit or negative margin businesses to now being very, very profit focused.
Totally. Yeah. I mean, we just, and that probably comes from, having kind of cut my teeth in the energy business where, it'd be very hard to sell somebody an oil and gas property and say, hey, this, this property's losing $10,000 a month. Would you like to buy it? Nobody's going to buy it.
Right.
And so I think probably that is where that comes from. Running profitable businesses just has always made sense to us. We don't want to own a business that it costs $20 to generate $10.
Right.
It's just whatever, no matter the growth rate. And there are some categories that we've invested. Food delivery is I'll even say people delivery. Delivering anything from one person's door to the next is just expensive.
Yeah, right.
And so those are businesses that we kind of stay away from. But we love profitable businesses because when the tide goes out, kind of like it has, we have at least two and probably a third business that are public market ready today that are the IPO market's closed for business, and so but they're profitable, right? So they can keep operating and they don't have to rely on the next $200 million round of funding to come in to keep offsetting the losses, they can keep operating out of cash flow, grow the business. And, it may take us an extra 12, 24 months to monetize than what we originally underwrote. But theoretically, that exit should be bigger at that point because it's a profitable business that has since grown revenue another, 80 to 100%.
100%. So for you, I mean, that's really, that's interesting to think about because to your point, as the tide goes out, the businesses that right now they're in an environment where they're not making enough money and they need the next round of capital to stay alive. I mean, a lot of those are going to die, right? I mean, just inevitably, unless they change something quickly, because if they can't raise money, they're going to be out of money.
Yeah.
Very interesting. So for you, I mean, I know you the profitability piece is huge. But for anyone listening who maybe is a founder, who's looking for funds, what are some of the key 3 to 5 things that you, Blake, kind of run through a company's, whether it's their P&L, strategy, just totally curious at a high level, what are some of the really big key takeaways for you that are the most important when you're evaluating a brand?
I mean, I would just say kind of high level stuff is, 50% gross margin or higher. We've seen some incredible brands that just have really, really tight margin, and it's just hard to ever get them to work. We like to see kind of 100% year-over-year top line revenue growth is always a positive. Category leading velocities. We don't want to own the 14th fastest selling kombucha company, right?
Yeah.
We want to be in the number 1 or the number 2. We look for extraordinary founders. It's we don't like to invest in businesses where somebody just kind of had a good idea and they think they're going to go make this business work. We want really extraordinary founders. We don't we say we don't invest in non-dominant players. We like people that are going to go in there and be the kind of the tip of the spear for their category. Me personally, I love brands that can be an entire platform versus just investing in a product. Right?
I love that.
There's a lot of great products out there that everybody buys and people love, and those can work out great. But we like to see. We'd rather you be, an entire protein lineup of high protein cereal, high protein bars, protein drinks. If you're in energy, right, like all the different use occasions and opportunities to take energy throughout the day that you're a product that can really expand that. So we've gone. Sorry, I'm getting a glare over here.
Oh, you're good.
We've done a few kind of name changes and things with some different brands that were maybe when they started the company were a little too limiting. Maybe it was talked about that, maybe the name of one ingredient was in the name of the brand, or so it couldn't expand to other other categories. And so those are all kind of some of the things that we look for initially. Yeah,
no, that makes sense. I know in my experience at our X Bar, for example, that was something the company as a whole spent a ton of time trying to figure out, because I don't know how much you know about their story, but obviously starting with the RX bar, and then we launched a nut butter, launched an oatmeal, launched a different version of a bar, and trying to figure out how we create this platform. And the platform became, it was just, we had a couple different things. But I remember going through that because we were like, do we call it like a nut butter RX bar nut butter, or do you call it, and we ended up calling it RX was like our brand. Right. And then we called it RX nut butter. But I totally understand what you're saying. Yeah. And it allows you to have, sorry, go ahead.
I didn't mean to talk over you there. No, I mean, it's exactly right. When you think I could just see these founders when they're building them, I'm going to have the biggest bar, and then they get there, like probably quicker than they ever thought they would. And they're like, well, shoot, what am I now? And
yeah.
You always hear the saying that every time revenue grows 3x, and then you're a whole new company. And different set of issues, different set of benefits and things like that. So
totally
that's
true.
What I worry about with some of these kind of creator-led brands, that are obviously doing incredible numbers. Jake Paul's got the Prime, and
I was gonna say like celebrity kind of led.
Kind of in that same vein, like when you take him, if somebody comes in and acquires that business, and he goes, like, is he an ingredient, for that brand to succeed, or does he have such, does the following that he's created that has driven all that revenue stay loyal to the brand, or do they run off to the next thing? And that's just one of the things that we're kind of watching on a lot of these kind of social media type led brands.
I would actually love to dive into this area for me. Well, I guess a good question. Have you ever been, or did you go to Expo West this last year?
I did. Yeah.
Yeah. Okay. So I was out there. While I was at our Expo, I never made it out there with the team. I went this year with my business, and me and my co-founder went. And for me, it was so eye-opening, just how many brands there are. First of all, number one, it's just amazing. And those are only the brands that were able to purchase and afford a booth, right? Like there were so many others we knew that were walking around. The one thing that stood out to me was the number of celebrity-led CPG brands there versus any other year that I had heard of. Like that was a very common thing that stood out. And I know from my side of things, it does seem like that is something that's becoming more and more common. It seems like those brands just get this huge leg up where at launch, whether it's a D2C brand, they're launching on Amazon or even in retail, they just have this huge social following. So inevitably day one, their sales start at a place where if someone just starts with a good idea, it's going to start way behind. But for you as an investor, is that something that actually is kind of a concern? Just because of what you just said, like the Jake Paul example, or is that something you just try to get out if they decided to sell, you try to, leave with that sale type of thing? That's really interesting.
Yeah, no, it depends on how authentic it is, right? And just slapping a celebrity on a brand doesn't work anymore. It's got to be super authentic. The days of, Michael Jordan saying "eat your Wheaties" and everybody goes out and buys Wheaties. I think those are kind of behind us,
right,
for the most part. But you look at what Jennifer's doing over there at Once Upon a Farm, right? Like it's super authentic, and it's like, yeah, she's a farmer from Oklahoma, like wants to make a better for you, healthier baby food like that.
Right.
It really comes across in her lifestyle and everything that she does. But yeah, celebrities on a brand are one thing. Celebrities, investing in a brand, or, you see that quite a bit. Their money tends to be a little greener than other just people that just can write a check. And so they get some benefit there. But some of it's funny. I mean, we've been in brands alongside like, Leonardo DiCaprio, and they're like, okay, well, what are you going to do? He's like, well, I'm not going to do anything. Well, can we mention you in the press release? No, don't mention me in the press release. It's like, why did you give us money?
Oh, really? So there are some that just don't even want to, they don't want to be attached to it at all.
Don't attach my name. It's like,
interesting.
Which to me is like, so maybe you really do genuinely believe in this company that it's the best like financial return profile that you can find, or is it?
It must be like they think the financial return's there, but they genuinely don't, like their agenda outside of this investment doesn't align with what the brand's doing or something. That does seem weird, because you'd think the more they talk about it and promote it, it's going to just benefit them down the road. So that's funny.
And he's probably kind of unique. It's probably not a fair assessment across the board, but
sure.
I've seen that, and it's kind of bizarre to me. But
yeah, no, that does seem very strange. Well, really interesting. So when you think about the brands that are tied to celebrities or social media influencers, is it a more attractive opportunity to you? Because I've talked to brands and worked with a few brands that are in both these categories. Would you prefer it where the celebrity is invested and maybe talks about it, but isn't really involved in the day-to-day? Or do you like the ones that are, because there are some that are like very heavily involved in the actual like day-to-day of the brand, and they don't necessarily have the background in it, but they want to be a part of it.
I think it's too early to tell. I think it's, obviously, you immediately think of, Aviation Gen and Casamigos, and I think celebrities probably look at that and they're like, wait, those guys made how much money? Like spending how much time doing that? And then it's kind of everybody tries it at once. But I don't. off the top of my head, I can't think of a lot of other. Well, I guess the Honest Company. They've had.
Yeah, that's a good one.
But I don't know. I feel like it's a little too early. And really, the three examples I gave are not like content creator. They're not creator-led brand. They're really celebrity. Those are like celebrity brands, right? And so, I don't know. I mean, with the content, you got Onda. You have Chamberlain Coffee, and you have some of the others that are Prime. But we had the conversation last night at an event with what Mr. Beast is doing. It's just like
so it's funny. Small world. Mr. Beast, the old CEO of RX Bar that came in after Peter, who started it, after he stepped down. Jim, who came in after, he's now the CEO of the chocolate bar company. So that's a good one. I know the other one that an old RX, my old boss, actually, our CFO, is now the CFO at Zoa, which that one with The Rock is really interesting, right? Because he's so involved, and he posts about it constantly, which I always I use them as a shining example of what can happen if you actually get a celebrity that loves the product they're actually talking about. It probably helps that his face is all over it, but at the end of the day, he genuinely loves that, and he posts about it every day. And every time he posts about it, they sell out. I mean, it's a great business model. It works really well.
His following is pretty extraordinary. Down here in Texas, we have Troy Aikman's the Dallas Cowboy, three-time Super Bowl champion. He's kind of making a run in the kind of better for you beer category, but for some reason he's very good friends with The Rock.
Oh, okay.
And, I guess The Rock's a former football player, but The Rock's he'll post about Troy's beer, and when we do, we see this total lift in the brand, and you're like, oh wow, man, The Rock's got this. He's got the golden touch. So.
He does. His following's insane. I can't remember how many he has. He has some ridiculous number of followers. That's cool though. I didn't even know Troy Aikman was into better for you beer. That's cool.
Yeah, we're generally pessimistic about craft beer.
Okay.
It was one of the first kind of categories to go ultra craft and ultra almost down to which neighborhood you live in.
Yeah, super craft.
Yeah, so that gets really tough. But when I saw kind of how competitive Troy was, and he's entering this to win, not to have a hobby. I mean, he's in this to win it, and he announced last week. He was actually one of our guest panelists at the Venture Dallas event, and he announced last week it was the fastest growing craft beer ever launched in Texas. So,
oh wow,
we'll see where that ends up. But
very cool.
Yeah, it's he's another one I guess that comes to mind.
The only other one, and I work with these guys and love these guys. They're it's been a passion of mine. But in the CrossFit space, RX Bar obviously did a really good job of building a business on the back of that CrossFit community. I work with, and I've had them on the podcast before, Podium, which is a supplement company that was started by Matt Frazier and the Buttery Bros, which are they're probably three of the most well-known faces in that space. But they're the same way. Their following is not The Rock, but it's still pretty big. I think cumulatively have a few million followers. And so whenever they make videos or post anything, they're always using the supplements, and it's such an extension of their daily routine, right? I've always thought beer is alcohol is tough because unless you're drinking every day, it's hard to always post about it. But things like protein and pre-workout for guys that work out like they do constantly, it's so organic and part of what they're doing anyway. It's they'd either have a brand deal or they started their own brand, which is really interesting to me.
Yeah. And I think we'll see a situation where instead of just grow, cross our fingers. We hope that we can IPO or a strategic buys us or, kind of greater full theory, right?
Yeah.
It's I think we will see a situation with especially some of these lifestyle type brands that, you know what, now they're doing $200 million a year revenue. They're profitable businesses, and they're just going to distribute $30 million a year to investors,
Oh, yeah.
They're going to get paid, and that's how everybody's going to make a return on their investment. I think that, we'll start to see that.
Is that something I've never really thought through that. Is that something that is happening today very much? I feel in the world that I live in, I would tell you 9 out of 10 brands that I talk to, I mean, inevitably their goal is to build it like our X Bar did and sell it, right? They want to like have a huge exit. That's really interesting though. If you had a really profitable base and you're able to raise capital and have an investor base that just gets paid yearly or quarterly or whatever it is on a very profitable business, that to me seems like a really interesting opportunity.
We're in one of those supplement business that we get a quarterly. We do actually get a quarterly distribution check, and it's amazing.
Wow.
They're highly profitable business, 72% gross margin, and they distribute, and when they distribute to all the investors, then the founders get their distribution and for their ownership, and you grow the business that way. And that's kind of, I don't know if you know Human Co. Jason Cart down in Austin.
Oh yeah,
it's kind of what he's building with Human Co. is kind of a platform for founders that may not want to sell their business after 5 years, or they may want to run a profitable business for years and years and years, and that's kind of what his part of his thesis is. So.
Got it. Okay, that's really, really interesting. Is that which one to you is more appetizing, given your firm and everything? Is there one or the other that is more of a strategic play for you?
Long-term capital partners. And, we don't have institutional capital that really pegs us in a 5 to 7 year window, and so we really have if we have a business that's growing 30-40% a year and it's year 11, we love that. We do want to see returns at some point, and so whether they decide to lump sum, exit, monetize that, or start making distributions, we're happy either way.
Got it. Very, very cool.
We're fine being long-term partners. Yeah.
Okay, that makes sense. To back up a little bit, just about your firm specifically, one question I've always been interested in learning more about. So you talked about your very first investment, where that was some of your capital plus you got family and friends that commit. When you started Access Capital, how does that process work for folks who have just never learned about this side of the industry? So did you at that point, like you started a firm and then you go out and you try to raise money from a variety of people to start a fund, and then you're ultimately responsible for doing the due diligence and passing along, like, hey, this is the opportunity we want to use your cumulative funds to then invest in a brand? Is that generally how that works?
Generally, yes. Two different ways. I had to start off risking my own capital because I had to build a track record that I knew what the heck to look for and what was a good opportunity versus not a good opportunity.
Sure. And
I think just in North Texas, I won't even say Texas, I'll say North Texas. Generally, I feel like when people hear the word venture, because we're really early stage growth capital, we're not like true like angel, seed, pre-revenue, pre-product type investors.
Right.
But I think, if you live in Austin and you hear the word venture, you think opportunity. And if you live in Dallas and you hear the word venture, you just think risk. Like, it's gambling money, I'm probably going to lose it. So that was a hurdle that we had to overcome, right? So early on, I talked to some family offices and some of our backers, and they said, well, when we write a check, we really like to know exactly what we're buying. We want to know we're buying company XYZ, so why don't you go find company XYZ, and we'll, you negotiate, decide what you think the investment should look like, and you come to us, and we'll tell you whether we're interested in backing that investment or not.
Okay.
So and then you do enough of those, and you have a track record, and you have some exits and put some points on the board and make some distributions, and then they start going, you know what, you're the pro, like, we don't want to make decisions, can we just allocate capital to you? And then you draw that capital whenever you see a good opportunity.
Got it.
So then that's how we transitioned from really doing maybe 3 SPVs a year, where it was, hey, here's the opportunity, here's the category, here's the team, here's the brand, here's whatever that we think we want to write a $10 million check into, to, okay, let's do a committed fund. And so now we actually do a combination of both, where we have a $15 million committed fund, but wrote $66 million in checks past 12 months. And so,
wow.
Can't write $66 million in checks out of $15 million fund.
Yeah, that doesn't balance. Yeah.
So it's a lot of kind of SPV where we think maybe the appropriate size for an opportunity is maybe $1 million, $1.5 million from the fund, but we actually would like for Access Capital to have a $5 million exposure into this company, and then we'll fund the growth that way.
Got it. Okay. So when you say that, are you then borrowing money, or you're going outside of the fund to raise additional funds? Or which way?
I'm going to our LP base and saying, here's what you'll own within the fund. If you'd like to allocate additional capital to this specific company, then this is what it would look like.
Oh, got it. Okay. Very interesting. So you have a fund, and then you have additional opportunities, essentially, that if a high worth net.
Yeah, it's co-invest, SPV, it's a lot of different terms for it. But.
Okay. Got it. And then for you, and this is one side that I think is really interesting for people to learn too. For you, then are you then making money and earning your living as there's big exits? It sounded like you have some deals maybe where there's some dividends, but how does it work? Or do you have like a salary? I've always been curious how venture firms, like how that all works. Like, how do you make your money? You know what I mean?
Yeah, we'll get real personal here.
Yeah, no, and don't share anything that's too personal, but just at a general philosophy.
Here's your tax return over here. I'm kidding.
Blake's like, what did I sign up for?
No, it's fine. It's fine. And, historically, I'm happy to have full transparency. Historically, I probably had a little bit of imposter syndrome and didn't feel like I deserved a quote-unquote management fee, especially early on. And so I structured all my deals as no management fee. Investors are going to make this preferred return. After you get 100% of your investment back plus this preferred return, then Access Capital will collect 20%. And then after a while, you realize that, there are bills between when you make an investment and when you exit an investment. And so with the fund, we do charge, I think it's a 1% annual management fee. And then in the past probably year and a half, 2 years, we've started charging just a 1% management fee, which is it's an annual management fee that pay. But then once we exit the company, investors do get their full investment back. They get their preferred return back, and then 80-20 after that. So, whereas hedge funders may come in here in a 2 and 20, and crazy guys may charge 3 and 30, we're like 1 and 20 after payout plus pref. So and I did that really. I never wanted to get into the AUM game. Mm-hmm. I saw too many people get, and I see it today. They have success with, their first $50 million fund, and they go raise a $300 million fund, and then they raise a $600 million fund, and they're making so much money just off clipping management fees that they get bad habits and they get kind of lazy. And they're really not chasing that. They're really not, I feel like, being great stewards of the investors' assets and really trying to get to the biggest back end they can. They're hey, I have a really high AUM and make a couple $1,000,000 a year. Yeah. And don't have to go to work, don't have to go to work every day. And I never wanted to get into that. I felt like not charging a management fee or charging a very, very low management fee, very minimal, was motivation to me to make sure that these companies have super successful exits so that we can all share in that, kind of back end monetization.
No, I love that. Your whole philosophy of building your business sounds similar to what happened to me when I built mine. It's like you want to have your skin in the game, and I think that makes so much sense. I feel the same way. It's like being close to the business, actually feeling like your skin's in the game. Like it makes you work 10 times harder than the guys that are probably just skimping by and hoping a couple deals work out because they're making a bunch every day, every month, every year just for running the account, right? That makes a ton of sense. I love that. Very, very cool. So one of the other questions that I know we're starting to get a little low on time, but I really wanted to ask this. I think it's really interesting for people who, again, are in the CPG space who maybe are listening to this that own a brand. For you, I know profitability, high margins, those are really important. And I know just from listening to you on other platforms, kind of like a revenue. Well, actually, it'd be good to talk about it a little bit, but curious on what size of revenue is appetizing for you guys. And then the other one that really stands out to me, because I've my RX story of just being there and then seeing a lot of brands now, it's changed a lot, I feel like, in the last 10 years. What is, like, from your standpoint, revenue, and then from a distribution perspective, important? Like, do you like to look at brands that have really strong e-com businesses, but still have the big retail players to unlock? Do you like to see some retail exposure and e-com? Just really curious where your head sits on, like, what you think the right path to market is across all the different distribution points.
Yeah, we like a really strong retail. Probably, frankly, really, really high velocity and really small total door count, right?
Okay, yeah.
For pure revenue, we like businesses that are at least a minimum of $10 million a year revenue or more. We don't have institutional backers, and so that gives us a lot of leeway in how we can structure a deal. Mm-hmm. It gives us a lot of leeway. I'm not, I can only invest in Series B or later. I can only invest in seed and Series A. We can invest in anything. The last two businesses we invest in, one was doing $20 million a year, and another was doing $580 million a year ARR.
Wow.
So
Wow.
there's a
Big
lot
gap.
of leeway there. We're definitely more kind of opportunity driven than we are trying to fit a bunch of different upfront metrics. But yeah, I mean, there's been a big. We have some digitally native companies that we had this conversation last week too, where it feels like they've gone like full circle, right? Because it's so hard to acquire customers now with the iOS update that
Right.
they're like building out brick and mortar storefronts, and they're back to like that's how the original way to acquire a customer, right?
Sure. Oh yeah.
Hundreds of years that have a store and people walk in and buy your products, and so so we're seeing an emphasis on that. But if I'm if there's a beverage that's only sold in 7-Eleven, but it's the number one selling beverage within that category, and they just got into Target, but they still have unlimited number of retailers to expand to, we love to see that. If they're posting really high velocities in Austin, and the same people are coming in and buying it again and again, and then they're also doing that in Colorado, and then now they're about to expand into California, and we can see that the brand is kind of traveling to other states and putting up similar numbers, and we love to have an entry point at that time also.
Makes a ton of sense. It reminds me of, I'm sure you know the Super Coffee guys, but their story, I've had Jordan on here a couple times, and they always talked about in the early days how important it was once you got one door, you didn't move on to the next door until you were crushing it at that door, and that meant in-store demos, that meant basically anything and everything to help not just get product on the shelf, but move product off the shelf, and then move on to the next retailer or the next door even in that retailer. Really interesting.
That's important. I mean, we love to give high fives whenever you get on shelf, but we love to give you a big bear hug whenever you get it back off the shelf, meaning velocity. And so that's we love that strategy, kind of inch wide, mile deep, and because you learn a lot, and they're not expensive learnings. One of the big red flags to us is when we come in and the company doesn't have much of a track record, and they roll out here's our nationwide platform that we're moving to. It's like, man, that sounds really, really expensive and really, really risky.
Definitely. Yeah. Part of my past life, I led like revenue management or like trade spend management at RX. And it was always just so eye-opening to me, especially if you're like at RX's level. We had a big business. So being able to manage ebbs and flows of trade spend that was not expected that came in, or expired product, just issues with product. Like, we were able to take some of those bumps. But for brands that are just smaller, more nimble, especially the ones that I talk to that don't have the margins, when I hear they're going into these massive national retail plays, yeah, I agree with you. It always feels like a big red flag. I'm like, just, you want to be careful. I always say, like, even if your pricing feels right when you're going in, there's so many unexpected things that are going to come back and you're going to be billed for. Guaranteed. I can guarantee you there's going to be a lot that you don't plan for. Very interesting. Yeah.
It's a lot better when that issue happens in one market than it is when that small issue just happened in 40 different markets. It's like,
right.
Geez.
Right.
Okay.
Yeah, 100%.
You know?
Yeah, definitely.
So
Definitely. Well, awesome. Blake, with the last few minutes here, I have a couple questions I love to ask every guest that comes on the podcast. I think you're gonna have some good ones. I'm excited for. The first one is source of knowledge. So someone who's very dialed into this industry. If you have a podcast, a book, an article, something you've read recently that you'd like to recommend to the audience listening today.
yeah, I mean, I read a lot about the Stoics, right? And so The Obstacle is the Way, Ryan Holiday, great book. I'm for better or worse, I consume a lot of information off Twitter. And,
Okay.
So it's kind of, but that's been kind of like the last probably 6 months, and so I'm considering doing like a Twitter purge to see if maybe I can't tell if it's like the environment and every news seems bad, right? And so I was kind of looking for the boogeyman, but I think I may just delete the app for a little bit and see.
I like that.
See if the happiness and joy kind of increases a little bit, or if it's truly all these things going on in the world today continue to hover over us. So
that's a good one, because I feel like the same way with I don't read any mainstream news. Like, I don't watch news, I guess is a better way to put it. But I have like just the Google News app, which I know, just knowing Google, I mean, that is so curated. Like, especially if I'm on the For Me, it's all algorithm based. So it's not necessarily like headlines. It's just what it thinks I want to click on. So I need to do the same thing. I need to just put it all away. I think that'd be a healthy thing to do, Blake. We'll both do it. Maybe January, we both just get rid of the social media and Google News. That's great. That's awesome. The second one. So, knowing you run a very successful and very busy firm, what do you use day to day to plan goals and really ultimately get shit done? So are you a pen and paper kind of guy? Do you use some sort of app, calendar? What are like your key tools that you use to manage your life? Love it. Yes.
I'm an old school guy. I'm the faintest of pen is sharper than the mightiest sword, or whatever it is. It's I do a couple things, right? I at the beginning of each year, because that always feels like a good kind of take inventory of your life, assessment of your life. I'm a big believer in you're most like the 5 people that you surround yourself with.
Mm-hmm.
So I'm fortunate to have a incredibly strong, intelligent, beautiful wife, and spend most of my time with her and our kids, but take inventory of my friends, right, and who I'm spending time with, who I'm going to dinners with, and making sure those are the right people and their hearts are in the right place. And then I tend to take a little walkabout out in Marfa, Texas, out in Texas, and get some windshield time, get out there and do some journaling and do some goal setting for the rest of the year. And I usually come back from that pretty revived and haven't missed much work, because it's the turn of the year anyway. So, but it always feels super fresh. And then I do use a handwritten calendar, and so that gets a little tight. We got 3 kids at 3 different schools now, so that gets a little tight when it's social and work.
Yeah, I was going to say.
And then I just use a simple, at one point I had a bunch of sticky notes everywhere, and that was kind of driving me crazy. So at the end of the day, I sit down with just a standard note card, and I say, here's the schedule for the next day. Here are the things that have to get done. And then here's kind of the stuff that if I do find some spare time, I'm going to go do this. So
very nice. Just real simple.
Like most people have been trying to focus on, mental health and, meditation. Meditate's the only one that I never actually scratch off my list, so that I it's like my personal reminder to add it to the next day's
I love that
routine as well. And then,
Do you have any sort of meditation? Do you use like an app, or do you use any just no?
The floor right over there. Yeah.
Love it. Okay, no, that's great. That's a good one. I've been using Headspace for a while. Not that I'm like pro app or Headspace or anything, but yeah, it's crazy. It's one of the only things, minus exercise and just general fitness, that I've told people. I'm like, if you consistently meditate, it's hard to explain the benefits, but you feel them.
Honestly, when I meditate, I feel like the days are 34 hours long and not 24 hours long.
That's a great way to put it.
It's like, and even though it's taking time out of my day to do it, I'm just like, where did I get? And I don't know if because it's providing clarity or a reprieve from the noise or what it is, but I just feel like I have so much extra time. When I do it. So.
That's a fantastic way to describe it. I love that. Blake, very last one here. For anyone who wants to learn more about you, learn more about Access Capital, or I don't know if you want necessarily throw out anything for someone to get a hold of you, but if you wanted to offer that up to you to plug that in.
Yeah, LinkedIn's probably the best way. I will say I've historically taken somewhat of kind of a crouching tiger mentality. We don't have a website. There's a few people that I really admire here in Dallas that have great businesses that literally they just have a landing page, and so we don't have anything super elaborate like that. I'm on social media, and then LinkedIn's probably the easiest way. I didn't start LinkedIn until probably a year ago, and it's the easiest way to kind of reach out, and if it's something that we're interested in, then we'll reach back with personal email address and then follow up.
Very cool. Well, Blake, thank you so much. It was a pleasure meeting you and getting to talk to you over the last hour. It was really, really nice to finally make the connection live, and let's definitely stay in touch. This is awesome.
Yeah, Shane, I appreciate it, and we'll definitely see you at Expo West. It sounds like
definitely. Yeah, I'm gonna have a little one. We're expecting our first in January, so that'll probably Thank you. Very excited. So, yeah, we're excited. That'll probably be my first trip. So nice. I'm excited. Very, very excited.
Yeah, you'll be asleep. You'll be asleep at the hotel by like 8 p.m.
100%.
Well, that's awesome. If you're ever in Dallas, please reach out.
Definitely. I definitely will. Awesome. Well, thank you, Blake. It was a pleasure meeting you. And again, thanks for coming on.
Thank you, Shane.
All right. See ya.